somewhere in your portfolio right now. A stock could reprice 15% overnight, and earnings have nothing to do with it. The culprit is a trade deal review, and after 2026, that review happens every single year. Most investors have never heard of this mechanism, and that gap is already costing them. CUSMA, also called USMCA in the US, governs roughly $2 trillion of annual North American trade. It replaced NAFTA in 2020 and was supposed to bring stability to cross-border commerce. Buried in the text is a 6-year review clause. The first one lands in July 2026. After that review, any party can effectively put the deal on a 1-year rolling lease, renewable or terminable each cycle. Think of it this way. Your landlord can now renegotiate your rent every 12 months, and you have to stay in the building regardless. Businesses that depend on cross-border supply chains face the same uncertainty. Call it the lease tax. The lease tax never appears on any income statement. It hides inside risk premiums instead. When risk premiums rise, valuations fall, even if nothing else about the company has changed. The sectors most exposed to the lease tax are autos, agriculture, energy, and advanced manufacturing. Together, those sectors represent a significant slice of the S&P 500 by revenue exposure. Estimates cluster around 25 to 30%. Hold a broad index fund. Roughly $1 in 3 is touching this risk. Those dollars are not necessarily lost. They just carry extra uncertainty already priced into every quote. Uncertainty shows up in markets as volatility, measured by the standard deviation of returns. Historically, spikes in policy uncertainty have pushed sector volatility up by several percentage points. Academic work on the Baker-Bloom-Davis Index puts the range at roughly 5 to 10 points. Higher volatility widens your range of outcomes. The best case gets a little better. The worst case gets a lot worse. On a $50,000 portfolio, 5 extra points of volatility translates to roughly $2,500 more swing in a given year. Not catastrophic, but that is the price of holding the lease tax without knowing it. There is a mathematical reason higher volatility quietly erodes compound returns. It is called volatility drag. A portfolio averaging 10% annual returns, but swinging 20% compounds to roughly 8%. The formula is arithmetic mean minus half the variance. That 2% gap is the lease tax showing up silently in your compound growth rate. Over 20 years at 8% instead of 10, $100,000 grows to roughly $466,000 rather than $673,000. A gap exceeding $200,000. No crash required, just the lease tax compounding quietly in the background. To see why the lease tax exists at all, you need to understand how modern North American supply chains actually work. Industry analysts estimate a single vehicle's components cross a North American border multiple times during production. Some estimates suggest 6 or more crossings on average. Each crossing is a potential tariff point if CUSMA terms shift during a review cycle. Broad tariffs on intermediate goods can add thousands of dollars to a vehicle's production cost. Industry estimates range widely depending on tariff level. That cost either compresses margins or gets passed to consumers. Either way, earnings suffer. Markets price stocks on expected future earnings. Uncertainty about those earnings lowers present value today. Standard DCF math shows that a 1 percentage point rise in the discount rate cuts present value meaningfully. The exact amount depends on duration, but the direction is always the same. Trade uncertainty adds a policy risk premium, effectively raising that discount rate with no Fed action required. For a stock trading at 20 times earnings, a 1-point discount rise compresses the multiple toward 18 times. A rough but illustrative approximation. On a $50 stock, that compression is roughly a $5 haircut, not from bad results, just from the lease tax. We have seen this before. NAFTA renegotiation uncertainty from 2017 to 2019 is the closest available case study. During the peak uncertainty of 2018, auto sector stocks broadly underperformed the S&P 500, Relative gaps of 10% or more were widely reported. Agricultural processors showed similar drag when tariff headlines hit. Price declines of 10% or more were common in exposed names. When a deal was confirmed, those sectors snapped back sharply, showing the lease tax is reversible. Investors who panic sold during the dip locked in losses and missed the recovery entirely. Two paths open up when the lease tax hits, and one is dramatically more expensive than the other. Panic selling locks in the lease tax permanently. Staying informed lets you manage it rationally. Studies of the 2018 tariff episode show patient holders meaningfully outperformed panic sellers over the following 12 months. Behavioral finance researchers put the gap at well over 10%. In factor investing, trade uncertainty loads heavily on two factors: value and momentum. Value stocks in trade-exposed sectors, CP/E ratios, compress faster than the broader market. Momentum reverses sharply when trade headlines flip. A stock up 20% can surrender those gains in days. Factor models calibrated on comp period data routinely underestimate tail risk during review windows. That is the lease tax appearing inside your factor model, quietly widening actual risk versus estimated risk. Diversification works because assets move independently. Correlation near zero gives you the smoothing benefit. During trade shocks, correlations across North American sectors spike sharply. Diversification breaks down temporarily. During the May 2019 tariff escalation, cross-sector correlations in North American equities rose markedly. Readings above 0.8 were widely observed. When everything moves together, a 20-stock portfolio can behave like a much smaller one in terms of effective diversification. This is where the lease tax gets expensive. It borrows against your diversification benefit. Canadian investors face an amplified lease tax because Canada sends roughly 3/4 of its merchandise exports to the United States. That concentration means a CUSMA disruption hits Canadian GDP proportionally harder than American GDP. The TSX has historically shown greater sensitivity to CUSMA-related headlines than the S&P 500. The asymmetry is structural, not accidental. A Canadian investor holding only domestic equities has not diversified away the lease tax at all. Trade uncertainty also moves currencies. The Canadian dollar typically weakens when CUSMA risk rises. A weaker Canadian dollar is a hidden tax on imported goods. Groceries, electronics, and vehicles all cost more. During the 2018 NAFTA uncertainty, the Canadian dollar weakened noticeably against the US dollar. Purchasing power took a real hit. Every cent of weakness on a $1,000 US purchase costs a Canadian buyer more at the till, the lease tax showing up in your wallet. Rather than predicting outcomes, smart investors use expected value, probability times payoff for each scenario. Scenario 1, deal renews smoothly, the most likely outcome historically, with modest positive returns for exposed sectors. Scenario 2, contentious review with partial tariffs, a meaningful probability carrying double-digit sector drag. Scenario 3, breakdown and broad tariffs, low probability but severe, with potential drawdowns exceeding 20% in exposed sectors. Weighting those scenarios, the expected value tilts slightly negative. The lease tax costs more in expectation than it returns. Those probabilities are illustrative estimates. Nobody knows the true distribution of trade policy outcomes. Not knowing even the true probabilities is itself a risk. Economists call it Nietzschean uncertainty. Under Nietzschean uncertainty, markets tend to overshoot on both fear and relief, amplifying lease tax swings in both directions. This is why relying solely on NAFTA-era backtests may underestimate future volatility. The geopolitical context has shifted. The auto sector is the clearest example of lease tax exposure. Here are the numbers. North American automakers source a large share of parts from cross-border suppliers. Industry figures commonly cite 30 to 50%. Broad tariffs on those parts raise per-vehicle production costs significantly. The exact figure depends on tariff level and model mix. If automakers cannot pass costs to consumers, Operating margins compress. Thin auto margins leave little cushion. Margin compression on a stock at 15 times earnings can imply a double-digit percentage price decline. The math is straightforward. Agriculture faces a different flavor of lease tax, retaliatory tariffs rather than input cost increases. During the 2018 trade tensions, retaliatory measures on North American agricultural goods caused measurable revenue losses for farmers on both sides of the border. Canola, pork, and steel were primary targets in 2018. Retaliation is targeted, not random. Agricultural stocks with heavy cross-border exposure saw earnings estimates cut during that period. Cuts of 5 to 12% were widely reported. Canadian oil and gas exports to the U.S. represent well over $100 billion annually, a substantial lease tax target. Energy sector stocks tend to price in tariff risk through a wider WTI-WCS spread, a technical but very real cost to Canadian producers. Each dollar of WCS discount widening reduces Canadian producer revenues meaningfully. The relationship is roughly proportional to production volumes. That revenue loss flows directly into lower free cash flow, weakening the valuation case for energy equities. Index funds give you broad exposure, but they also give you broad lease tax exposure without labeling it. The S&P/TSX composite carries heavy weight in energy and materials, both highly CUSMA-sensitive sectors. A passive investor in a Canadian index ETF is implicitly taking a large CUSMA policy bet without knowing it. This is not an argument against index funds. It is an argument for knowing what is inside yours. Many investors benchmark against the TSX or S&P 500, but those benchmarks carry the lease tax too. Relative outperformance during a lease tax event can still mean absolute losses, an important distinction. If your portfolio drops 8% but the index drops 12%, you beat the benchmark and still lost 8% of real money. Absolute return thinking, not just relative, is what actually protects your purchasing power. One structural response to the lease tax is geographic diversification, spreading exposure across trade zones. Equities with primary exposure to Europe or Asia-Pacific carry near zero CUSMA correlation in normal times. Adding international allocation has historically reduced portfolio volatility. Academic work consistently finds 1 to 2 percentage point reductions for moderate international weights. That reduction partially offsets the lease tax drag on your compound return. The key word is partially. Geographic diversification reduces, but does not eliminate the lease tax. Investment horizon changes everything. The lease tax bites much harder for short-term investors than long-term ones. Over a 20-year horizon, trade policy cycles tend to mean revert. The lease tax averages out over time. Over a 2-year horizon, a contentious review can permanently impair a position before any recovery arrives. Matching your exposure to your actual time horizon is one of the most underused tools in retail investing. Rebalancing, not panic selling, is the mechanical tool for managing rising lease tax exposure. If CUSMA-sensitive sectors have drifted to 40% of your portfolio, trimming back to 30% is rebalancing, not fleeing. Systematic rebalancing forces you to sell high and buy low, the structural opposite of panic behavior. Research consistently shows disciplined rebalancers outperform reactive traders over time. The margin is meaningful. Within trade-exposed sectors, the quality factor offers a partial lease tax shield worth understanding. Quality companies, high return on equity, low debt, stable margins, tend to draw down less during policy shocks. During the 2018 tariff shock, high-quality industrials held up noticeably better than low-quality peers. The gap was substantial and widely observed. The quality premium during lease tax events is not guaranteed, but it has been consistent across multiple trade episodes. Trade review timelines create predictable windows of elevated lease tax. You can map them to the earnings calendar. The CUSMA review process formally begins 6 months before the July 2026 deadline. January 2026 is the first watch date. CUSMA 2026 earnings calls for CUSMA-exposed companies will likely be the first to quantify the lease tax explicitly in guidance. Watch guidance language, not just earnings beats, for the earliest signal of lease tax escalation. Sell-side analysts typically model a base case of deal continuation. The lease tax rarely appears in consensus estimates. That means consensus price targets for CUSMA-exposed stocks may be systematically optimistic. The gap could be 5 to 10% or more. When the lease tax does appear in earnings, the surprise effect amplifies the price drop beyond what fundamentals alone would suggest. Analysts anchor to deal continuation because it has historically been the most common outcome, a well-documented behavioral finance pattern. Before acting on anything in this video, stack up the caveats. They are as important as the analysis. Your personal tax situation changes the math significantly. Capital gains timing can offset lease tax drag. Transaction costs from repositioning can eat the benefit. Trading too frequently is its own silent tax. The lease tax is one risk factor among many. Inflation, interest rates, and credit risk all coexist with it. Overreacting to a single risk factor is itself a portfolio risk. The cure can exceed the disease. The real value of understanding the lease tax is not predicting outcomes. It is avoiding surprises. An informed investor who expects volatility does not panic when it arrives. That is a genuine behavioral edge. Behavioral edge compounds over time, just like financial returns. Avoiding one panic sell can be worth years of gains. The lease tax is loudest when investors are least prepared. Preparation is the antidote. 3 signals are worth watching as 2026 approaches. Trade balance data, political rhetoric, and currency moves. Trade balance deterioration between CUSMA partners has historically preceded contentious review negotiations. Sharp Canadian dollar weakness in a short window has historically been a reliable lease tax signal. Watch for outsized moves. Political rhetoric scoring, tracking how often officials use tariff language, has a measurable lead on sector moves. None of these signals is a trading trigger. They are inputs to a more informed expected value calculation. Zoom out. CUSMA or its successor will almost certainly continue in some form. North American economic integration runs very deep. The lease tax is a periodic friction cost, not a structural dismantling. That distinction matters enormously. Long-term investors who understand this can hold through lease tax events without permanent impairment. The compounding math still works in your favor over decades. The lease tax just requires you to stay in the call. Let's tie the numbers together. Volatility drag from the lease tax costs roughly 1 to 2% in compound return over a full cycle. On a $100,000 portfolio over 10 years, that drag represents tens of thousands of dollars in foregone wealth. Awareness, positioning, and behavioral discipline can recover a meaningful portion of that drag at essentially no cost. That is the entire point. The lease tax is not inevitable. It is manageable once you can see it. The trade deal protecting $2 trillion of North American commerce is now on a yearly lease, and you know that now. The lease tax hides in risk premiums, volatility drag, correlation spikes, and analyst blind spots. Understanding it does not require predicting politics. It requires the mechanics we covered today. The investors who navigate 2026 best are the ones who started thinking about it in 2025. If this changed how you think about trade policy and your portfolio, subscribe for more quantitative breakdowns. And share this with one person who holds Canadian or North American equities without knowing what's inside. This video is for general educational purposes only and does not constitute financial, investment, tax, or legal advice. All statistics and figures are illustrative estimates based on publicly available data and academic literature. Past market behavior does not guarantee future results. Consult a qualified financial advisor before making any investment decision.